let's get started. We want to be cognizant of your time. So, good day and welcome to the Risk Readiness webinar. I am Shay Scarpa, Associate Product Manager, Business Solutions at the Risk Management Association. Today's webinar is the latest installment of our Credit Trends in Commercial Lending Credit Risk Navigator presented by Tom Cronin from AFS. During the presentation, if you have a question for the speaker, please submit using the Q&A feature at the bottom of your Zoom screen. We will address as many questions as we can at the end of the presentation. We will also be conducting a demo and also answering questions at the end of the demo. At this time, I'd like to turn it over to Tom Cronin from AFS. Thanks for joining us today, Tom.
Thanks, Shay, and thanks for pinch hitting for Ann Adams today. Again, I don't understand why she took vacation instead of attending this webcast, but I guess she has her priorities.
Beats me.
So hello to everyone, and thanks for joining us today. I'm going to, if you've been with us before, I'm going to deviate from the usual C&I CRE order today and start off with CRE. There's been a lot of conversation about the problems with office properties and how that's impacted CRE. So we want to show you what we're seeing for offices, and then what also we're seeing for the other property types, because what we're seeing is not just offices, and you'll see that in a second. And as I mentioned last month, and Shay just mentioned, at the end of our analysis, we'll be conducting a short demo of the CRN dashboard, because we've had a lot of requests from people to see that. So here we go. Let me move it on. So the source of our data, as usual, is the Credit Risk Navigator. It's the oldest monthly commercial loan benchmarking service in the US. We have, matter of fact, I checked this before I came down. We now have over $1.1 trillion of exposure in this database. And we started collecting data and benchmarking the data in the third quarter of 2003. And we'll talk more about CRN and what it does in the demo after the data analysis section, but just wanted to give you an idea of how we get our data and what we do with it. So we're going to start, as I said, with CRE and a quick definition. When we say CRE or investor-owned real estate, we're following the interagency guidance. And that directive basically says if more than 50% of the loan repayment comes from the sale or rental of the property, that's CRE. And again, you'll often hear this referred to as investor-owned properties. So we're going to start with our performance trends. And the three performance measures that we have, the green, 30 to 59 days past due, the blue, 60 to 89 days past due, and the red is what I call non-performing. That's 90 plus days past due plus non-accrual. And this chart shows the performance measure since we started analyzing CRE in 2010. And the recent changes are hard to see because coming out of the recession, the non-performing levels were extremely elevated. So I want to flip over to the next page where we're looking at the more recent results. And here we've scaled down the time period to the last 4 years plus a few months. And outside of the initial COVID-related spike, you see there with the green on the far left, the short-term past dues have been hovering close to 0.5%. Although recently, it's been a little north of that amount. As you can see, we're at about 55 right now. But it's been basically in the 0.50% range. And the blue line, the 60, 89 days, not much movement there. It's kind of stagnant or flat, if you would. The non-performing number, though, the red, is a bit different. In late 2020, early 21, we hit what I call the COVID-related high of 1.35%. And then we started to improve, and by early 2022, we'd gotten back down to 0.81%. But since then, it's been a very slow and steady increase. And we're now at levels we haven't seen for 10 years, prior to, obviously way prior to COVID. So I thought we'd take a look at the various property types and see what's causing this problem. So here we have the non-performing trend by property type. And these are the 8 largest property types. And when I say largest, I'm talking about outstandings in the CRN database. And as I said before, there's no secret. Office is the highest and performing the worst. And along with mixed use is just above 5% non-performing. And while we don't have names in CRN from our CCAR work that we used to do, we know that a large part of the mixed use is office retail type facilities. And that sort of stands to reason given what we're seeing with offices. So most of this mixed use is probably has some basis in office, so that kind of fits. But we're also seeing elevated levels for residential, retail, and even a slight increase for industrial and multifamily. Now, I want to chat about multifamily just for a second, because we've heard a lot of concern in the trade journals regarding multifamily and the negative impact of a large number of apartments coming online. Specifically in the news over this past week, there was a high-rise hotel in Atlanta called Generation Atlanta that was foreclosed on, the $104 million loan. The owners had bought this assuming at a high price, assuming rents would increase. When they bought it, rents were $2.60 a square foot. They're now $2 a square foot. There was also a property in New Jersey called Optimus Lofts, 212 units. That was foreclosed as well. So you're seeing the glut of new properties force prices down, and a lot of buyers had over leveraged and are starting to run into problems. We're not seeing it here, but this is something we're going to take a look at, continue to take a look at, because it reminds me of what we heard about offices maybe 3-4 years ago. And we just want to make sure that this doesn't get out of hand. So let's move on and take a look at non-performing for CRE by geography. And a quick clarification, with CRE, when we say location, it's based on the address of the property, not the borrower. So here we have the split of the CRE portfolio by our 6 regions. And let's start with the good news. We're seeing an improvement year over year for the Northeast. And again, this is July 23 versus July 24. Pardon me for not saying that. And the increase in the Northeast, or the improvement in the Northeast, is primarily due to an improvement in lodging and, surprisingly, multifamily. But now the bad news. We're seeing dramatic performance declines for the South, the Southwest, and the West. And I thought we should take a little bit closer look at those. In the South, we'll go into the state level in a second, but in the South, we're seeing troubles with office and multifamily. In the Southwest, it's a combination of office, multifamily, industrial, and residential. And in the West, it's office, industrial, and multifamily. So you're beginning to get their repeating theme here. Let me switch now, and we'll look at the state level. So this is the southern region, the states within that southern region. And we're going to look at this for the South, the Southwest, and the West. So the biggest change here is for Louisiana, where almost entirely those problems are for multifamily. Now, Florida, over to the left a little bit, has the most outstandings for any state in this region, and the non-performing levels there almost doubled due to offices and mixed use. And we also saw a big jump in Tennessee, and that was due to multifamily problems. Now in the Southwest, we're seeing dramatic increases for 3 states, Colorado, Texas, and Utah. In Colorado, the problems are with office and a little bit of retail, which is kind of the first we've heard of that. In Texas, we're seeing issues with office, industrial, and residential properties. And in Utah, the problems are for healthcare facilities and offices. Now we'll move to the West. And we're seeing increases for 4 states. We'll leave Nevada alone because that was sort of small. California, the increases are due or not due to just a single property type. We're seeing problems there, jumps in non-performing for just about everything, specifically increases in industrial, mixed use, and then offices, multifamily, and residential. In Oregon, we see problems for multifamily, office, and lodging, which is probably the only state that had an increase in lodging and non-performers. And then in Washington, no surprise, office and multifamily problems. So when we got together last month, this was one of the questions that we had received, was basically, can you tell us what's happening at the individual level? There was concern, particularly from one of our customers, that office properties where they were residing were actually doing better than the rest of the market. So that's what we wanted. That's why we did this today. And we hope this kind of gives you an idea of what's happening region by region and state by state. We did want to look one more time at non-performing trend, and this is by the commitment size. So if it's a $10 million deal, it comes into the 10 to 25 million range here. And there's increases for every size, but what's really surprised me, I think, the most was the increase for the parts syndication piece. And almost all of this increase has resulted to issues with syndications of office properties. There's a little bit of retail syndications in there, but most of this jump is due to offices in the parts syndy. And that's really, I think, something you normally don't see. Parts syndies tend to be more of an item in the C&I world. They're not that prevalent. They are prevalent, but they're not that prevalent in the CRE world. And to have this amount of problems with them, I think is sort of striking. Okay. So we're going to move on to credit quality, but Shay, we want to launch our first poll.
Yep, you got it. So this is our first poll question. Can you guys see that?
So this is, go ahead.
So the question is, over the past year, what has been your bank's approach to loan to value requirements for CRE loans? Okay, we'll give it a few seconds. Tom, can you see the results?
Not yet.
Okay. Give it another 15 seconds. We have about 60% of the participants answering. All right, I think it's slowing down. So I am going to launch these results here and share.
About half, no change.
Yep.
About half tighter. Okay.
All right. Thank you.
Well, thank you. All right, so now let's move on to credit quality. And quick explanation, if you're new to joining us first time, I'll explain what I mean by distress. So when a bank joins the Credit Risk Navigator, we map each bank's native borrower risk rating scale, regardless of what that is, to the RMA 10-point scale. And on the RMA 10-point scale, borrowers rated 1 through 6 are called pass, with 6 being low pass. 7 through 10 are criticized, with the standard regulatory definition, 7 being special mention, 8 substandard, 9 doubtful, and 10 loss. And then further, 8 through 10 are also categorized as classified, which is what you see here in the blue. So our risk migration work has shown that a significant portion of the 6s migrate to criticized. So we've added the 6s to the criticized and call that grouping distressed to get a better view of what I call the at-risk loans, particularly in times of economic uncertainty, which I think is where we are now. It appears doing better, but I think things are still a little bit up in the air. So we're going to stick with this distress for a while. So here you see the distressed from when we first started mapping CRE. And coming out of the recession, CRE experienced a decade of improving credit quality. That cycle was temporarily interrupted by COVID, peaking towards the end of 2020, And then similar to what we saw with the performing numbers, it improved steadily until the fall of 2022. And at that time, we saw a negative shift in credit quality. And the overall percent distressed hasn't been this high since 2013. So we're at an 11-year high, if you would. So let's go in and take a little bit deeper look at what's rated the worst. So this is what I call our above the line chart. And what we have is the percent distress for each of the larger property types in the columns. And the horizontal line is the percent distressed for all CRE. So any column that's above the line, above the dotted line, has above average levels of distressed properties. And offices is the worst. But you also see issues for lodging, industrial, and multifamily being above the line or above average. Lodging we know is coming down. Industrial and multifamily have actually gone up. So not what you want to see in terms of credit quality for some of the property types that people, I think, in general think are safe. What we're hearing with the industrial properties is that as we've come out of COVID and people have gone back to shopping in person, the percent of e-commerce sales has flattened, and a lot of warehouses were built, spec warehouses are not being filled. The vacancy is ticking up a little bit, and so the outlook for industrial properties, which is primarily warehouses, is not as favorable as it once was. And the multifamily, we've talked about that, how the overbuilding there is putting pressure on rents. So that's CRE. So now I'm going to move on to the C&I world. In a brief definition, we define C&I, or commercial and industrial, as borrowers that have annual sales that are usually north of $1 million. And loans to these borrowers are manually underwritten and risk rated, so delinquency or exception managed loans are not included in here. And then wealth management or private banking loans that are for business purposes are included, as are owner-occupied real estate loans. So before we jump into the performance trend, we wanted to go to our second poll question.
Yep. So for poll question number 2, as a portfolio manager, when analyzing concentrations, which factors are most important to your bank? For this poll, you can select more than one answer. So we'll give you guys about 30 seconds to submit your response. Looks like it's all over the place right now.
And we've asked this question before, but I wanted to get an update on it because this is one of the questions I use to help decide what we want to show here from a segmentation standpoint.
Okay. Yeah, so we're still getting some responses in here. We're about 67% of the participants submitted. Give it another 2 seconds. Okay, and I will end the poll time. And here are your results, where it looks like collateral and industries was the most rated here.
Okay. I appreciate that, because collateral is something I usually don't show. That gives us something to talk about maybe next time we're out.
Okay, great.
All right. Okay. So here we go with C&I performance. And you're going to see a little bit of a difference here for C&I versus what we just saw for CRE. Part of the reason why I put C&I second. This is our performance chart. Again, short-term past dues in the green, medium past dues in the blue, non-performing, which is 90 days plus past due, and non-accrual in the red. And the COVID, after the COVID closures, C&I portfolio saw non-performing levels rise, peaking at 1.2% in October of 2020. 2 years later, the performance had improved and was hovering just near 0.5%. Unfortunately, the impact of inflation and high interest rates moved the percent non-performing level since that time to about 83% earlier this year. But unlike CRE, C&I performance has basically leveled off since then. And for July, we came in at 0.76. So unlike CRE, which has continued to rise, C&I has leveled off, and we thought we'd take a look at why. Before I look at the non-performing, I'm going to look at delinquency ratios. And I'm going to issue the caveat that I do almost every month with delinquencies. And matter of fact, let me back up. You can see the green line, how volatile this is. And to try to make an assumption month after month or month versus month, I think is foolhardy. You really need to look at, say, the 6-month average. But I'm going to look at what the rates were with my above the line chart as of July, just to kind of give you an idea of what's happening for past dues. This could easily change next month, but I thought we'd take a look at it because we haven't looked at it in a while. And what you see here is surprisingly, the sector with the highest past due level is 92 public admin. And historically, 92 public admin has had a sterling performance. So when this number came up, to be perfectly honest, I'm shocked. I was shocked at this. And obviously, I'll take a look at this next month and see if this was just a temporary phenomenon or if something's happening in that marketplace. This is your government, agencies and municipalities and things like that. So I don't expect this to stay that way. The other things that we're seeing are past dues for some areas such as 56 admin, 61 educational services. We've seen that before. Those sectors tend to have problems from time to time. So those weren't particularly surprising. But again, I don't put a lot of stock in a month-to-month change on delinquencies, but we'll take a look at this next month just to make sure public admin has come down. So now we'll move on to non-performing. And this is our same style, my above the line chart, as I call it. And when this one came up, I wasn't quite sure where to start with or what to mention because there's so much happening. So I'm just going to try to boil it down to 2 quick comments. We talked about how 92 admin was the worst sector for past dues. Here you can see it's one of the best on non-performing. So I've got to believe that 92 delinquency you saw is just a temporary aberration. Then if you move over to the left-hand side, you see 11 agriculture is the worst. And this has been happening for a while now. We think it's relatively isolated to tree nut farming in California. But again, this is something we'll keep an eye on. But after 11 agriculture, the next worst, or the next one down, is 56 admin. And within 56, we're seeing higher levels of non-performing for security guards, specifically in the mid-Atlantic states, business support in the southern states, and employment services in the mid-Atlantic and the West. So all kind of areas that are office related. So while not, specifically office properties, all office related issues, and just exasperating the problems with offices. So here's our new chart. This is a new measure, and everything we've been looking at before has been a percent of outstandings. This is looking at the actual number of borrowers. And what I have here, we started this measure in January of this year. So I have the change in non-performing borrowers from January 2024 to July 2024. And with this, I think you get a sense for the overall movement of a given sector that's not influenced by a few large loans or possibly influenced by a few large loans. And more than any other single sector change, I think what's most notable is that every sector, with the exception of oil and gas and utilities, have seen an increase in the number of borrowers with non-performing loans January versus July. So the overall, in terms of number of borrowers that are having problems, is increasing throughout almost every sector in our database, particularly you see in transportation and healthcare. So this is something that we'll be trotting out every month, and just try to keep track of what things are, how things are changing. All right, Shay, I'd like to launch our last poll if we can.
You got it. So we have our third poll question. And this is, over the past year, what has been your bank's approach to loan covenants for C&I loans? And this is a single choice like the first poll. And we will keep this open for a little over 30 seconds, make sure everybody's participating. All right, results are coming. Kind of even, I feel like, slightly even on some of these responses. I'll keep it open for another 5 seconds. About 72% of you have submitted. All right, I will end the poll, and Tom, you should be seeing the results where it's about the same for majority of the group.
It's interesting that most of them are just still about the same. So, okay. All right. Okay, so now we'll move on to credit quality for C&I. And once again, so this is the distressed, low pass and criticized. So low pass, special mention, classified. That's what I'm calling distressed. And this chart, this percent distress trend, has basically been mirroring the non-performing results. A year ago, so July of 23, the overall percent distressed was 22.4%. As of July 24, the overall distressed is 26.7%. So we're up, 400 basis points, somewhere in that range. And we're actually seeing increases in all three of these categories. So just very quickly, I'll go through that. So low pass, the blue, was 16.8. It's now 19.3. Special mention was 2.87. It's now 3.1. And classified, which are the worst category, was 265. It's now 429. So if you view risk ratings as a projection of what's coming, the outlook is not as favorable as I think you would like to see. So let's look at the above the line chart for distressed. And of note here is all three manufacturings. So 31, 32, and 33, just a tad above, all above the line. And within those sectors, you're seeing problems in 31 for food and beverage manufacturing, in 32 for chemical and plastics, and for 33, problems are projected problems for fabricated metals, computer, and transportation equipment. And then 45 retail is also one of the highest. And we've talked about this before. And a lot of this is due to sporting goods and hobby stores as a result of the inflation hitting consumer discretionary industries. We've seen this quite a bit. All right. So that's the data part of the presentation. I did want to mention quickly our schedule for the rest of the year. So next month, we will be having our semi-annual user group meeting. So there's no open webcast. So the end of the month, don't be looking for us. The next webcast we'll have will be on Halloween, October 31st. We'll be showing the 3Q24 results. And I'm going to be introducing a new metric, which I'm calling the performance quality metric, that I've developed over the past year as a result of a lot of these poll questions in terms of what's important to you and what do you look to when you try to measure. And then our last webcast for the year will be on December 5th. We'll take off Thanksgiving and come back the next Thursday with our end of the year review. So Shay, before we jump into the demo, I'll open it back, send it back to you and see if there's any questions, and then we'll get on the demo.
Of course, thanks for sharing those updates. Very helpful, Tom. But it doesn't look like we have any questions that are coming in right now. If anybody does have a question, feel free to pop that in the Q&A section, and we'll be happy to answer that for you. And also, just as a quick reminder, we will be sending out this deck once the meeting concludes. And of course, you can always view this recording on our website at any time. We don't see anything for questions, Tom, nothing in the chat either. So I think you're okay to power forward.
Okay, let me go get the demo. And this has been sitting a little bit, so I'm going to refresh it. And while it's refreshing, let me take a second to kind of explain what you're going to see. So in the Credit Risk Navigator, we have, pardon me, 3 web pages. The executives see up there at the top, the executive summary, the early warning problem management, and the concentrations web page. And what we're going to look at today is concentrations. And the reason, I hope I don't sound preachy here, but the reason why concentrations are important is we've heard from the rating agencies. They've said that they will downgrade you a notch if you're overly concentrated in a risky sector. And a downgrade can result in a very meaningful increase in borrowing costs. I just happened to look it up today. So the interest rate for BBB rated credits is 5.16, and the interest rate for BB is 5.62. So on a $100 million debt offering, that's a difference of almost $500,000. So this has very very significant financial impacts, and is something that you need to know and be aware of, let alone the examples you've had over the past year and a half or so. So Silicon Valley and its reliance on tech, New York Community Bank and its reliance on multifamily, and then Citizens Bank in Iowa that had a reliance on trucking that went under in November of 2023. So here's the concentrations webpage. It has 5 different tiles or segments that you see here: industry, geography, etc. And we have a number of filters that'll enable you to select and boil down. So right now we're at the high level. So we want to come up and say, let's just look. So we're at industry, and we want to look at C&I loans. So I'll click on C&I, and you'll see the chart changed. And you can see the predominant C&I loan for this bank. Blue is, we'll just call this your bank. It's a demo bank. But blue is not as concentrated as some of the other banks are. It's up there though. But where you see the concentration for them is on the very next line. So 53 real estate, rental, and leasing. So a combination of those factors have them about 3-4 percentage points above the market. And that would be something that you would want to take a look at to see whether or not that particular industry is performing well or not. We went through a lot of that today about what's happening with real estate. This is a little bit different. It's not CRE properties per se, but still, I think you would find that there's some pressure there. The other thing that you can do then, so we're still on industry and C&I. A lot of banks want to know, okay, where are all my problem loans? So I can come into risk rating. I'm going to click on risk rating. I'm going to hit 7, which, if you remember, is special mention. And you'll see the change here. So if this was your bank, you can see that 30% of your special mention loans are in the finance and insurance. And again, these are the private equities, private credit funds, loans to industries that are then lending money out to usually highly leveraged this type of lending went away from banks after the recession, but it's kind of like an indirect lending. So you can see that 30% of your 7s are in this, and for most everybody else, less than 10%. So you obviously have a problem there. Again, if this was your bank, and this would be something that you'd want to take a further look at. We talked obviously a lot about CRE. So let's go look at some factors with CRE. So I'm going to go over to collateral, and I'm going to go up and select investor-owned real estate. And you can see what's your concentration of properties, the major property types. And you have more than 50% of your outstandings are in multifamily. Now, the market itself is a little bit above 40, but still you're more than half of your loans are in multifamily properties. And given what we just heard, I would think if this is your bank, you would probably want to take a look at this and see whether or not you should back off on that. I'm going to go over then one last time and look at risk ratings because, as I mentioned early on, this was the reason Credit Risk Navigator was put together so people could benchmark their risk ratings. We'll go up and select C&I. And if this is your bank, you can see you have over 40% of your loans in the middle category, so fives. You don't have a lot of sixes, so you tend to be a little bit better than everybody else, if you would. But you're a little bit higher in the sevens and eights. So you've got some pluses here and you got some minuses. And maybe you'd want to look at how you're actually doing your risk ratings. We'll look at this for CRE. And you can see there's a dramatic difference from the market. You're pretty much in line with fives. You basically don't have any sixes, where the market is saying a quarter of the loans, third of the loans are sixes. And you're risk rating a lot of your CRE loans as fours. Could be that's actual what's going on, or that's the actual credit quality for those loans. But you can see how using a tool like this enables you to spot outliers right away and helps you identify areas where you need to do some further investigation. All right, so that's what I had today. Shay, are there any other questions on this or anything else?
No, it looks like everybody is okay. No questions here. Let me just double check in the chat. Maybe something came in there and I don't see anything. So I think everything has been pretty clear, Tom, with the presentation and your demo, if there's no questions. But we can leave it open for another couple of seconds in case anything does come through. Any other additional comments, Tom?
I don't have any. Just remind people that we'll be back on Halloween.
Yep, we'll make sure we spread the word on that. And yeah, it doesn't look like we have any questions that have come in. So if you're okay, we can let everybody head out early and give some time back today. Are you okay with that, Tom?
I'm good. Yep.
Okay, great. Well, thanks so much, Tom, for sharing your insights, and thanks to everybody for joining us today. We look forward to having you at our next session in October on the credit trends. And this will conclude our webinar. Please take a moment once we conclude this event to complete our post-webinar survey. And just wishing you a great, happy long holiday weekend. All right, everybody. Thank you so much for joining us today. Take care.
Thanks, Shay.